Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Wednesday, the 23rd of February Bull versus Bear webinar with Steve Miley on the call for Trade Day. So, welcome everyone. We're going to go through our normal, regular run through in here today. Calendar, what we've had, what we've got coming up. Calendar getting very, very much sidelined in here by the bigger geopolitical threat that we see in Eastern Europe. With the Russia-Ukraine situation. We'll talk about that. Obviously, it's going to be a focus of today. We'll look at how that's impacting financial markets globally, and with a special focus or a more significant focus on the markets that I know that many of you guys are trading, which are going to be the stock indices, the Nasdaq and the S&P 500, plus the commodity markets. So we'll take a look at those. Certainly, going to have a little dip into the FX markets as well today, just to give you a little bit of a sideways look at how correlations, how other markets can affect other different markets, and how they can tell us something about maybe the markets we're trading. And we'll run through the major articles, some articles from the major news wires that are kind of that are tending to point towards what we're talking about, and the major theme in here, which is the Ukraine Russia situation. So let's kick off with the calendar, even though it is kind of marginalizing at the moment. It's even more marginalized today because there's nothing really of significant note in the calendar today. We have our Eurozone CPI data, inflation data, which is very much front and center. All of it you can see in here, all in black, all came in bang in line with expectations. So nothing to really of real significance there. A couple of ECB speakers, even when Christine Lagarde speaks, who's the head of the ECB, it's rare that it has a significant impact on financial markets. Sometimes when she speaks, it does, but certainly when when it's other ECB members outside of her, they rarely impact markets. Maybe a slight impact on the euro versus the dollar, but usually nothing too significant. So it's a light calendar. The API weekly crude oil stock data comes out here at 4:30 Eastern time later today. So that's, if anything, the focus of the day. Only really going to affect the oil market, not going to really affect the stock indices to any extent. So that's what we're looking at on the calendar today. Let's get into the nitty-gritty of what's really going on in here. So stocks are continuing their rebound. We had the sell-off in here on Monday through Tuesday, and then the intraday rebound yesterday when stocks rebounded as the US markets reopened, having sold off aggressively with the developments we saw on Monday through into Tuesday morning, with Russia recognizing the breakaway regions in Ukraine, offering peacekeeping support to those regions, and then the Western allies announcing economic measures, sanctions against Russia and Ukraine, or the breakaway regions of Ukraine because of that. So that is the dominant theme in here. However, markets, and I don't want to keep going on about this, but I've been speaking at this at length on the run into this. I've looked at this in the past. On the run into conflict, usually the markets go into risk-off mode, the equity markets sell off, and then the reverse happens when the conflict actually kind of starts, when we get some kind of resolution. And that's exactly what we saw. As soon as it got worse, the market started to rebound, okay, because a lot of negativity has been built in. And even when I've seen it, I think it was Iraq War 2, when the bombs were actually dropped, there was a lot of build up that it was going to happen, and when the bombs were actually dropped, the markets were very negative on the run into it. When the actual first bombs were dropped and the troops started to go in, the market rebounded almost immediately. So a similar thing we've seen in here over the last 24, 36 hours. Stock markets rebounding. We're going back into risk on mode. Remember, risk on, traders willing to take more risk. Okay, so we've gone back into risk on mode, and that's because you got the fact that really, to be honest, nothing's really massively changed on the negative side. This is a lot less worse than it could have been. Okay, so it could have been a lot worse than it actually is. So yes, we've got some Russian troops and tanks moving into those breakaway regions of Ukraine, and yes, we've had sanctions, but the sanctions have been fairly light in here. So world stocks bounce as the investors eye Putin's next steps in Ukraine. So we're not out of the woods yet. We're far from out of the woods yet. But and look, stocks rise with bond yields amid soft sanctions. The sanctions that we're seeing not particularly on the harsh side. Okay, so softer than feared sanctions. So that's kind of seen as a positive because the bigger the sanctions are, the more risk then you get retaliatory actions, and then also then sanctions are obviously negative for global economic growth. So the combination of the fact that there hasn't been a significant escalation in any actual kind of conflict, we haven't seen anything significant on that side, and also the sanctions that have been put in place are not particularly punitive. So because of that, we've seen a sort of almost a sigh of relief, and markets. When I say markets, I mean their equity stock markets, stock indices have rebounded. We've gone back into risk on mode. Investors, traders, risk on, willing to take more risk, shifting back to the risk off theme that we saw at the end of last week and the beginning of this week as things started to escalate and there were fears of a more significant conflict. That conflict could still be out there. That's why we're not seeing markets racing. Stock indices are not racing to the upside, but nevertheless, you saw a strong turnaround rebound. We'll look at the charts as we go forward in here today. So stock rise, but bond yields also rising. Okay, so bond yields rising. So that's higher prices. Higher yields, lower prices. So that's bonds selling back off again. Bonds selling back off. Remember, bonds rallied last week, at the end of last week, beginning of this week. Bonds are seen as a safe haven asset. Okay, a flight to quality, we say, a flight to quality into bonds. At the end of last week, beginning of this week, when they were more concerned about a more aggressive conflict, and now bonds selling off, going lower in price, higher in yields. Okay, so stocks rising and bond yields rising because of the conflict not being as bad as anticipated as yet, and also the softer sanctions. So that's what we're really seeing in here. And then treasuries then like reverting back now to what we were looking at before. Treasuries come under pressure. Okay, so treasury is selling off again, lower prices, higher yield as rate hike bets gain bigger. So we're going back to that rate hike scenario, which again is going to actually be negative for remember the fact that we're getting more risk of a larger hike priced in. And as it says in here, look, so 2-year notes, the 2-year notes led the decline in treasuries, with the yield jumping towards its highest since 2019. So 2-year notes are back towards the high yield, low prices that we saw previously in here in February. And now the Fed, the fact that the Fed may hike, have an increase of half a point is in March, is now up to about 40%. Okay, and it was as low as 13% on Monday. So come Monday, because of fears about the escalation of tensions, maybe then that was going to put the Fed on a bit more of a cautious footing. Okay, it's not that they're not going to hike rates, but only going to hike the 25 basis points. And we are expecting regular rate hikes now throughout the balance of this year. Goldman Sachs, JP Morgan saying that we're going to see quarter of a percentage point increases each of the meetings through the balance of this year. However, earlier this week in here on Monday, the chances of a half point rate hike were only down at 13%. And now they're sitting back up at 40%. Okay, so a fairly good chance. And we can see that there's a really good tool I want to show you guys in here. So this is, that's not it. This is it here. It's from the CME group. Okay, I hope that you can see it in the chat. I'm going to put this in the chat. So if you can see it in the chat, what I'll do is I'll also post this on the site activity. Okay, I'll put it in as a useful tool, so you'll be able to get it from the site and in the forums. So check that out in here. So it's from the CME, and basically you can go and see each of the meetings. So you see the meetings are up here. These are the dates of the meetings through this year. Okay, so you can click on the tabs to see the meetings, and then this gives you the chances of different kind of rate hikes. So in here you can see there's a 67.3% chance of a 25 to 50 point hike, and then a 32.7 of a 50 to 75 point hike. So basically 100% chance that they're going to be one of those two, either a 25 or a 50 basis point hike. But you can see now getting up towards like 40% now that we're going to see a interest rate hike of 50 basis points rather than just the 25 basis points. So it's a really useful tool. I will share that after the webinar into the forums. Okay, so I'll put it both in the forums and also on the site activity chat. So watch out for that. It's a really useful resource. Okay, so that's what we're going on at the moment. So stocks have rebounded. Here's the European stock outlook this morning. So you can see in here anywhere from up like a third of a percent to in some places up over 1% in here. So a strong recovery effort in here for most of the European stock indices, building on the recoveries that we saw yesterday. And if we go and take a look at what's happening on US in here, so US closed, even though we got the rebounds, did close lower yesterday. Okay, so we did get lower closes. S&P was still down 1%, down 1.5%, but they did rebound from significantly from their lows. But if we look again in here this morning, this is the futures markets. Dow's up 0.4. We have the S&P up over 0.5%, and the Nasdaq is up 0.85. You know, it's up 1 point today, nearly up 1%. The Nasdaq. So solid rebounds across the board. Again, in here, follow through from European stock indices and from the US futures markets in here today. So let's take a look at what's driving this. Well, we know kind of stuff in here. The weakness, we've already covered this. So the weakness in here, weak source, let's say, sanctions, like sanctions, first tranche of sanctions, maybe more to come. The most significant thing in here was the halting of the certification of the Nord Stream 2 gas pipeline, okay, into Europe. So that was certainly significant, but nevertheless, sanctions seen as weaker than expected, so that's been a risk-on event, and then that's means we're seeing calmer commodity markets in here, calmer stock indices in here, and but still on tenterhooks in here. Okay, so we've still got but there's little sign of panic in global equity prices this morning as investors see initial sanctions as limited. Okay, so we'll kind of already run through most of that today, and then again in here covering from Reuters, world stocks bounce as investors eyes Putin's next step in Ukraine. And we've looked at these articles here. One thing that has been from this morning, not too long ago, DPR leader. Now, DPR is one of the breakaway regions. Okay, leader said Ukraine may launch offensive at any minute. So they're concerned. The Russian-backed separatist said he favours dialogue with Ukraine, but doesn't see a resolution of what that means. And then they're going to potentially look for help. He says there are no Russian troops in Donbass, but their presence is possible if the situation requires it. So, and they're right. Okay, so some sarcasm coming in there. So, so what we're seeing in here is, the regions in here looking to maybe call on help from Russia. Okay, so that's kind of obviously a slight negative, but nothing probably that we've not been expecting anyway. We've already looked at this little tool in here. The other thing to note in here yesterday, with yesterday's reopening, remember the US stock indices were closed on Monday. For the President's Day holiday, it reopened yesterday. And although we got that strong intraday bounce in here, the indices did close down. So the yesterday 1.4% on the Dow, 1% on the S&P 500, and 1.2 on the Nasdaq in here. And what it means was that the S&P 500 confirmed a correction. Now, a correction in technical speak is when a market is 10% down from its peak. Okay, so the peak for the peak close for the S&P 500 from early this year, it's a closing record high, and it closed 10% more than its record closing level, 10% down from its record closing level. So that's deemed a correction in here. But obviously since then we've had a strong intraday rebound yesterday, even though it closed 10% down, and also follow through to the upside on the futures markets. So the cash market's expected to open higher in here today. Right, little segue off, which is I wanted to talk about the correlations in here. So sometimes it's worth, and this might not be the case right now, but it's something that I wanted to introduce for you guys. Sometimes it's worth looking at. Oh, am I still streaming? Oh, let me restream this, guys. For some reason, it looks like it's lost the stream. Okay. So in here, hope you have not missed too much in here, guys. It looked like for some reason it stopped streaming my screen. But in here, so commodity currencies. I want to talk about correlation between different markets in here. So the commodity currencies are often seen as risk currencies, also known as risk currencies, and they tend to rally, go up and down. And commodity currencies, by commodity currencies, I mean those economies, the currencies in the economies that benefit from stronger economy, stronger commodity prices. So the likes of the Australian dollar is clearly one of those, producing a lot of raw materials. The Canadian dollar, Canada, net exporter of oil, and also to some extent the New Zealand dollar. So these are kind of also all the dollar block currencies. They're also called. They're all dollar currencies, and they the commodity currencies, the Aussie Kiwi and to a lesser extent Canadian dollar, have been pushing higher over the last week or so in here, gradually pushing higher and pushing higher again today. So they are seen as a proxy of risk. Okay, so a reflection of risk and continuing to nudge higher despite the Russia-Ukraine situation still in development in here at the moment. We are seeing the risk currencies doing well. So that's kind of a reflection in here that maybe equity markets can do well. Okay, so we also saw the RBNZ overnight in here. There was the RBNZ meeting. Were more hawkish than anticipated, and so the New Zealand dollar also rallying. So New Zealand dollar up 0.6% against the yen, and saying against the yen, so that's putting like a risk currency. So sometimes we have, sometimes Aussie yen or New Zealand dollar versus yen in the currency world is seen as what we call, again, it's like a risk proxy. It's a reflection. It's an echo of risk. Why? Because the Aussie usually does well. We're in a risk-on scenario. The Aussie, the Kiwi, and to a lesser extent the Canadian dollar do well when we're in a risk-on scenario. Okay, so when we're in risk-on, Australian dollar and New Zealand dollar rally, and then conversely, the yen is seen as a safe haven currency for various reasons, particularly mostly historical, but also to do with their budget and trade account surpluses, alongside the fact that we have a repatriation thing going on with the super low interest rates. So the yen is often seen as a safe haven currency. Okay, it's a flight to quality currency. So when we're in risk on mode, you don't want to own the yen. When you're in a risk off mode, when you're taking risk off the table, when you want to go to a safe haven, you buy the Japanese yen. So you often see the Japanese yen rallying against the dollar down, yen up when we're in a risk off scenario. So the yen is seen as the safe haven. So when you pair those up, the Aussie yen versus the Aussie versus the dollar versus the Japanese yen, or the New Zealand dollar versus Japanese yen, is seen as a really strong proxy for risk. And you can see again, the Aussie yen is up 0.5% today. Just said there, New Zealand dollar versus the Japanese yen is up 0.6% in here today, and that's echoing, reflecting a more of a risk on scenario. So we're back in risk on. So sometimes it's worth watching these. So if you get a breakout maybe in the risk currencies on the upside, it might be telling you that we've got a bigger breakout maybe coming to the upside on, say, the stock indices. Okay, so it's something to bear in mind to watch the cross correlation there. Right, let's take a look at the charts. Not a huge amount to add to yesterday. So we saw the intraday rebound anyway yesterday. The market didn't manage to, here's the S&P 500, sorry, on the daily chart. Now, I spoke about it needing to close above Monday's shortened session, the open in here. If it closed above the open, so the opening price there was 43.24 and a quarter, we would have an engulfing candlestick. So the body would have engulfed the previous day's body. We didn't get that. We got the lower close there, but you can see the market pushing higher again here this morning. So you did get a strong recovery. It's fell back lower, but holding on to the recovery effort that we saw through Tuesday in here, having sold off on the shortened session Monday and deeper sell off into Tuesday. And importantly as well, it did undercut these important lows in here. Okay, I think that was a significant move, but the market is held above the lows here. Now, I think it needs to clear back above yesterday's high. Yesterday's high was 43.5875. I think it's difficult to get too bullish before it clears above there. But if we step into now the 1 hour chart, you can see there's yesterday. We did break this little trend line in here, broke above this trend line. Let me just get rid of this trend line here. But we broke above this trend line in here. Just going to make this a bit bigger. Okay, we pierced it. Okay, came back then lower, held at the previous low. That was really important. We held at the lows here. They got the 3 lows in here. Market held right off these 2 lows here during yesterday's session, and then rebounded from there. And then overnight, it's been gradually climbing high. Now, I think until it gets above, and we're back above the trend line. So it pierced the trend line, came back lower. Then you got, if we can get above the high there, and that's yesterday's high. So as I say, 43.5875. Then I think it turns a lot more positive. Okay, at the moment, I think the jury's out. This could easily turn south. This could easily turn to the upside. And obviously, we don't know. There's a big event out there, potentially a big potential event. You've got a big potential for something to occur regarding the Ukraine situation. However, we can't second guess that. You have to be careful. Keep your stops relatively tight, reduce your trading size because of the increased volatility. But in here, I think if we can get above, certainly and get above the peak there. Now, you may want to go long through the overnight peak, which was only set in here an hour or so ago, so a couple of hours ago. So that's up at 43, 45 and a half. I would prefer to wait until it gets here, because with the volatility, if it breaks here, we could easily be up here somewhere like towards 44.10, 44.20, and there's still enough in the trade to wait for a signal up through here. Okay, so maybe waiting for a break above this peak in here. Okay, and on the downside, you've got various little levels in here. If it breaks down, again, don't really want to be waiting. You could have a little day trade in here just through these overnight lows. So they are gathering in the 43.12, 43.10. You got another low here, 40, just below 4300, 42.99. So there are options on the downside as well. At the moment, it's looking for me to the upside, but really, I think I will be hands in my pockets, not trading this until you get a firmer signal in either direction. And there's going to be the same story for the Nasdaq in here. Now, a slightly better recovery in here for the Nasdaq. So if we take a look at the Nasdaq, look, we nearly got the engulfing pattern on the Nasdaq, okay? Didn't quite close above Monday's high yesterday, but solid again in here today. We're much closer to yesterday's peak. And if we step in onto the 1 hour chart, similarly there, and look, remember we put this retracement on yesterday as well. So we got up to like basically the 50% retracement and couldn't quite get above the 50. Fell back lower. Look, held significantly the Nasdaq above the. Remember the S&P 500 got almost back down to these lows in here. Held significantly above those lows. So it's a much stronger close. Higher again in here this morning. Now, if it takes out that peak and it's near that 50% retracement we looked at yesterday, but if it takes out the overnight peak, yesterday's peak, now that's up at 14,108 and a quarter. If it takes that out, this looks like a really strong base. We're not really, we reverse this trend line. Remember, we've got that bigger trend line that comes in here. So let's just redraw that. So you've got this bigger trend line. So if it takes out the peak, it's going to be close to this trend line as well. That trend line comes all the way down from the 10th of February. So that's an important trend line there. If it can take this peak out and get closer and challenge that trend line, this is going to be quite a bullish signal. Then again, we can't second guess what's going to go on with the Ukraine situation. You actually have to just trade what we see in front of us. So again, it's kind of jury's out, but this looks like a basing pattern. Strong recovery after the dip back lower yesterday. Strong overnight session. Strong in here in the last, in the current bar, in the last hour. Okay, strong rebound, having a little dip back lower. Strong impulsive rebound in here. Looks like it wants to set up for a break above here. Cash market opens probably going to be key in here today with no US data ahead of the cash market open. So watching those levels there. Right, let me take a look and a quick nod to. I'm going to quickly look at the bond market. So you see that the bond market collapsing back lower. So back down lower in here. These are the US 10-year note. Very negative pattern in here yesterday, rejecting this recovery. Lower again in here this morning. Bonds certainly pushing to lower prices. This 10-year note, lower prices, higher yields. Let's take a look at the commodity markets. Now, remember, we're on the April contracts, the J contract, okay, in here on both gold and oil in here at the moment. Let's take a look at daily on the oil, first of all. Now, again, another new recovery high, dismissing this potential topping pattern, another new recovery high yesterday, but a kind of quite negative failure candlestick in here. So this is kind of like a dark cloud cover pattern. That's what that's called there, dark cloud cover. It's gone back, the body in here, it's not an engulfing pattern, but the body in here is halfway down into the previous day's body, right? So we actually nearly had a bearish engulfing pattern. Didn't quite close below Monday's open in here, but close to it. And we're bound through Monday's open in here now this morning. So looking negative there. And if I step in, it's a real tricky one. On my reports in here, I'm playing this from the long side, but there's real risk now. But when those reports were written last night, the market's drifted lower since last night. We've got lower low and lower high. We've reversed this uptrend line. So for day trading here, jury's out for me. If it gets back above the peak in there, and that's kind of semi-overnight peak, that's up at 92.37. It looks bullish again. It takes out the low down here, which is down at 90.64. It looks bearish again. Now, I think I had this low in here as my trigger point yesterday. On my day, no, here, I think 90.86. Yeah, so we broke 90.86. That was my trigger to turn more negative overnight. So through 90.86 now, the market looks like it's vulnerable to deeper correction, but probably now waiting either above the peaks here or below the lows here in here for the next significant leg. Okay, let's take a look at gold. Start off with the daily. So you can see in the daily, the market really reluctant. It was a bearish engulfing pattern. Sorry. Remember, look, yesterday's from a new recovery high. Remember, we looked at it fell just back from this peak in here on the April contract from May. Fell from just below that peak from May, and then we get a bearish engulfing candlestick. Yesterday's body engulfing the previous day's body, and also engulfing this little doji from the day before that, from Friday's trading pattern, and then lower. Now you got these string of lows in here. I think the low from Friday and from Monday are going to be important. You can see we're just holding above those lows in here this morning and rebounded. You want a confirmation. Remember, this market's been super strong. Yeah, every time it's gone to kind of start to signal a topping pattern, you keep getting strong rebounds in here. So you want to, before you short this thing, you want to be sure, right? So you can see in here this string of lows. Remember, we had this line going across yesterday. Okay, the market held that line, rebounded. Look, we're piercing that line. I'd want to see it at least below this low, maybe below these lows over here. Okay, so the low, overnight low in here is on gold is 1891.1. Then you've got here 1889.7 just below that, and then here 1888. I definitely want to see it through there, probably through this one as well. You may not want to wait for it here, but if it breaks all three of these, then this is definitely a topping pattern. It looks like almost like potentially a double shouldered. If it rebounds and fails, you've got almost two shoulders here, shoulder, head, one shoulder here, potentially another shoulder about to be built. You might get a little rebound, then a failure. If it's a straight failure lower, whatever it is, it looks like a failure pattern, a topping pattern, certainly down through this low over here. So the 1889.7, you might want to trigger in just below today's low. If it holds, then you've got the little down line here. So just get rid of that line. Sorry. In here, you've got this little off the very peak through here. And then you got the other one. Why have they all disappeared? This does this sometimes, doesn't it? Oh, there we go. So I'm going to draw this more accelerated line down through here. Whoops. That's not quite right. You can see the market already breaking the one. So it's kind of decision time for gold, right? That's not the greatest line in here, but, it's flirting with that line. The market's right at the decision point. Probably through that, I'll be 65 looking for a break lower, 65%. And that sits with the more bullish view on stocks, right? Stocks higher, gold lower in here. It's been bid up because of a safe haven, and maybe it's done its job for that for now, okay? So I'd be looking here. I think, that trend line's not the best in here, maybe just above this little peak here. So on the top side, back above 1903.2 would signal a more bullish tone. Right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day as ever. Please do stay safe out there. I will post this this in here, this link into the onto the site, into the forums, onto the site activity feed. So do take a look at it there. I'll be back with you with another Bull versus Bear webinar tomorrow on Thursday. Until then, take care, stay safe, have a great trading day.